Okay, cool. Well, thanks everybody here for joined by Fred and Tracy Rui. How are you guys doing?
Good, good.
Doing
Happy post-Thanksgiving to everybody.
Yeah, thanks. So we're going to talk about creating some valuable seller finance notes today. So you guys have a really awesome presentation to kind of share with us. So maybe we can start by just giving people like a little bit of background on you guys for the folks who are going to listen to this later, probably like on YouTube or the podcast who may not be familiar with you.
Go ahead.
Well, I got started with seller finance notes as an investor in 1988. And before that, I was exposed to it because I worked for a title company where there was an attorney that did closings and also collected payments, later to become known as servicing. And then I went to work for a company that bought those seller finance notes as investments, did that with them for 10 years, and then met Fred. And then we went out on our own and we've been buying notes for ourselves instead of an institutional since about 1997, primarily in self-directed retirement funds. We use credit lines and other things like that. So we love seller finance notes. It's what we learned the business on. We know there's also scratch and dent, big paper, that's non-performing, but we've always loved seller financing. And there's a big difference between the types of seller financing notes that are being created. And I know you share that passion, Dan, as well, with your recent purchase of Call the Underwriter. So congrats on that.
Thanks. Yeah. So I did that about, I guess it's been about actually 2 months now since I did that. And so like my learning curve has been really steep because I'm seeing how all different kinds of investors do it. And to your point, there's like a wide range. So I'm looking forward to doing this and I'll probably pick your brains on different things as we go through this.
And Fred, tell them how you got started.
Yeah, I started in 1991 in a 500 square foot apartment buying notes and flipping. I didn't have any of my own money, and just flipping them on to investors. Did that for a while. Then I went to work for the same company Tracy worked for a while, which is where we met. Like I said, in the late 90s, we kind of started our own company. The only thing we couldn't do working for a big institution was buy our own paper because it was kind of a little bit of conflict of interest as far as buying what you were trying to bring in. And we were bringing in anywhere from 10 to $20 million a month to the institution, which was great through a whole broker network and some in-house employees. So it was what we've done ever since. And so I love the industry. I love that it doesn't really matter what's going on in the economy. The only thing it changes is who we're buying notes from. So in a really good economy, people are selling off their notes to invest into other properties or get bigger and better. And then in a tough economy, people are selling off their notes because it's an asset and they need they need the instead of the small cash flow, they need a lump sum for something. So we've seen everything. And actually, after the COVID years, I think now we've truly seen everything. So it's interesting to see how it evolves. It's yeah, it's interesting to see how it changes. The essence of the industry, honestly, is the same as when we started. I mean, as far as, what notes are and how they're created and what makes a good note and a bad note. Now I think what's good is the tools we have and the tools we're able to, find them faster. Sellers know they can sell, so they're a little bit more sophisticated. So today we're going to kind of talk about, creating notes, which, you can market for notes and you certainly can. And unless you're talking about a network or somebody that can refer you more than one deal, when you find that deal and you buy it, you have to go find another deal. And creating notes kind of gives you the ability to control your own pipeline. If you go out and create notes, I don't know that there's like somebody that used to flip properties or something like that that isn't super excited about this and wish they'd known about it years ago because they realized how much money they were leaving on the table. So we're going to talk a little bit about that today.
Yeah, and creating valuable notes is really the sweet spot for the private investor because Fred talked about when we were in the institutional side and then we went out private. It's like, oh, we have to find our sweet spot as a private investor. And so, as Fred mentioned, controlling your pipeline, either creating yourself or teaching others to create notes that are valuable seller financing is really that sweet spot that a private investor that just wants to do a few notes or a few a month can really tackle and excel at.
No, that makes sense. And yeah, I've seen too, like investors have all kinds of different business models for creating notes. So to your
Mhm.
point, you can really come up with your own way of doing it and do it on as small or a big a scale as you want.
I think one important thing in a kind of an overview or a 30,000 foot going into this is that you may be creating notes to hold yourself, and that's usually what a lot of people do. And so create a good note that you're going to have less problems with. So that's one reason to pay attention to how you're creating notes. Maybe you never intend to sell it. Maybe, we talk a lot about creating a note that's sellable. That doesn't necessarily mean you have to sell it. That's just create a note that's not going to create problems for you later. We're not, we don't want problems. We usually typically people that create notes or have notes, we don't want, there's a reason why we don't do rentals and stuff as much anymore because, I don't want tenants and toilets and calls at 2 a.m. You want to create notes that are not going to be a problem for you, even if you never sell it. And if you create it's the same to create a good note that's good for you to hold is also the same note that maybe in the future, if something changes and you want to sell that note, you've created a sellable note. So it's kind of both of those paths.
Cool. Well, you guys ready to jump into it?
Yeah.
Yeah, let's do it.
Yeah. All right. I think you should be able to see it.
Yeah,
Yep, I can
looking
see
good on
it.
your side. Excellent. Well, here's what we're going to cover today. We're going to talk briefly. I mean, as much as we can. And what do we got? 45 minutes to an hour?
As much time as you want.
I thought
Uh,
6 hours.
six-
I thought we had 6 hours. So we're going to talk about, just to make sure everybody's on the same page, and if you're very familiar with it, then we apologize for the first 3 minutes or whatever, but hang with us. We're going to just make sure everybody's on the same page on what seller financing is. We're going to talk about how big the market is. This is something we do every year, and we're just going to have a tiny piece of it, but to show why this is such a big market and why is it good now to be in seller financing.
And then why do buyers and sellers even finance, and how can they optimize the terms if they do want to resell them and also fight against inflation?
Yep, we're going to talk about building your team, which is not outside what a normal real estate transaction is going to be. Just a couple different players you're going to want, kind of to have contact with. And we're going to talk about 10 steps to creating notes. Kind of this is our checklist of what we look at when we go through creating notes.
And then we are going to talk, one of our 2 favorite subjects is how to leverage all of this with some partials and wraps and just some different examples and how to create what you might have heard out in the market as an infinite return.
This is like a super crash course in all this because this is all stuff that any one of those we could do like a whole hour on. So
Yeah. We're going to, you guys are going to cover a lot of ground here.
yeah, we are.
We to keep it interesting and fast paced and actionable items people can leave with, right? So how are notes created? If we look at a traditional transaction, no seller financing, you've got Barb the buyer and Sam the seller. And normally, if Sam the seller had this nice property for sale and Barb the buyer wanted to buy it, she would go to the bank and she would get a loan, a traditional loan, and they'd do some underwriting on her, make sure she could afford to pay for the home. She had a down payment. Sam the seller would give Barb the buyer the deed, and then Barb the buyer would sign a note mortgage or note deed of trust, depending on your state, back to the bank. And she'd make payments to the bank, usually for the next 30 years, maybe 15, but that would be a typical transaction. I think everybody who's bought or sold real estate completely understands how those bank originated notes are created. But what we want to talk about today that's a little different is how seller finance notes are created.
Yeah, and so most notes are exactly the way we just showed right now, and that's 95% of all notes out there. That's just typically involves a bank, but there is a significant number, and as you're going to see as we unveil the numbers of how many are created, where the seller acts like a bank. And typically this is a situation, and we'll talk about reasons why the seller would do this, but this is typically a situation where you'll see a for sale by owner, and you'll see owner will finance. For sale by owner just means they're trying to kind of skirt the whole real estate agent fee, and they're hoping to get lucky and someone walks up and not pay the one side of it. But when they say owner will finance, that means they're willing to accept the payment. So instead of there being a bank, Sam the seller is going to essentially be the bank, and she's going to make payments to him. So we'll show how that works.
And there could be a real estate agent involved. We
Yep.
see seller financing with or without a real estate agent. As Fred mentioned, the important part is that the seller is willing to accept payments over time. So really, Sam the seller just becomes the bank. So in addition to giving Barb the buyer the deed, he gets the note and mortgage, and she makes her payments to him instead of to the bank. And that's what it looks like in a nutshell. So let's just look at what a typical transaction might look like with seller financing.
Yeah, so the sale price of the house is say $200,000, and Barb the buyer has $40,000 to put down, so that leaves $160,000, and that's what essentially is going to be the note. And she's going to own the property, and Sam the seller is going to act like a bank, and she's going to mail the $1,374 a month. Excuse me, if the note is written at 9.75, and she's going to mail those payments every month.
Yes, so those payments would go to Sam the seller. Now it's a little bit higher interest rate, as we'll talk about. That's optimizing terms if you're for holding or for resale. And so that's what's going to happen over time. And you might say, well, how big is that owner finance market? Well, it might surprise people. It usually does, that there's 28 billion with a B dollars in seller financed paper created that's of public record across the United States last year. And if you add up the last 5 years altogether, there's over 125.5 billion of seller financed paper. So it's not as big as the traditional market, but it is a sizable market that is enough for players like us private investors to get involved in.
Yeah, there's more notes than we could ever buy. And I think that's a number that kind of surprises everybody, is how big it really is. If you look at, $28 billion in 1 year, that's up from 22.5 billion. So it's a 24% increase. We've seen years go up and down, so that's not necessarily important that it went up 24%, because like I said, there's always been more notes there that we can buy. Roughly last year, there were 89,773 notes created. So a few more extra notes than there were before.
So yeah, we're seeing it go up in dollar volume and number of transactions. And it's interesting that this is across multiple property types, as we'll look at. It isn't transactions that are recorded where the seller owned the property and sold it to the buyer and allowed them to make payments. This doesn't include private loans. There's lots of private lenders out there who don't own the property that might do an investor transaction, investor loan. But these are actual properties where the seller was deeded and on property, they deeded to the buyer and took back a note mortgage in their name.
Yeah, so if you look at the numbers, and this just gives you kind of the last couple of years, and we do this every year, so we kind of always do a trailing 5 years is what we keep track of. So it's $125 billion in the last 5 years. And that doesn't mean that anything before 2019 is not still out there, because it is. We just tend to use this as a cutoff for ourselves. Now, it's not all buyable. It doesn't mean that every single note of that $28 billion is necessarily a great note that any one of us would own. We can kind of back into the numbers a little bit and go, well, how much is really a good note or a bad note? But you can still see that there's an increase as we break down the categories. We do residential, commercial, land, and we have an unknown category. And you can see over the years, because of technology, we've been able to drill that number farther and farther down. Tracy hates the unknown category.
I do.
Because we don't know what it is. It's safe to say, though, the breakdown of percentage between residential, which is always the biggest, then commercial, then land, it's safe to say that the unknown category is roughly the same breakdown percentage-wise.
And that's just because we pull data from our data provider from the county records, and not all counties are created equal in the depth of data that they provide.
Yeah, I'm surprised you guys were able to get this data, because yeah, county records are super challenging.
They really
It's
are.
a lot of number crunching.
And people always say, well, that's great, but what's going on now? Well, one of the things we talk about a lot is, and we'll get into why sellers finance, why buyers finance, but what we see is when it's harder to get a traditional loan, then it becomes, seller financing starts to increase. It's always there, but when the markets tighten a little bit on traditional loans, we see more seller financing. And that's happened in the last few years. If you look at the mortgage availability index that the mortgage banker put out, it's really hard right now. It's very hard for people to qualify. They have to have more down payment. They have to have better credit scores. And they're having troubles qualifying because interest rates are high. And so their payment goes up. And now their debt to income ratio, how much their expenses are for the home compared to how much they make, gets tighter and more restrained. And so those things are making it tougher. Plus, banks have gotten careful, as they probably should have after 08 on the subprime mortgage meltdown. They don't want that to happen again. So what's going on now is that it's a very good time to be involved with seller financing, because there's good notes that you can create that are good for buyers, good for sellers, and good for an investor.
Yeah, and I think it's important to realize that, when we talk about interest rates, as far as, traditional being, say, 7% versus 4% or whatever it may be, just because if you don't qualify at 7, you don't necessarily qualify at 4, because of since 08, they've tightened up those credit margins. Now, could you buy more property if it went down and you already qualified? Yes. But if you didn't qualify before because of other reasons other than debt to income ratio, lower rates don't help you.
So let's talk about why seller financing, because people get all excited and they think every deal now is going to be a seller finance deal. But we know, working with sellers and buyers and real estate agents and investors, that not all deals and all situations make good seller financing. So why would a buyer finance? So usually seller financing comes from a buyer issue, a property issue, or sometimes it's an investment strategy. So we're going to start with, why do buyers like seller financing?
Yeah, so if you're buying the property and the person selling the property is willing to seller finance, you like it because there's not a lot of costly loan fees, if any. Literally, everybody's just covering the actual costs of closing the deal. You don't have PMI, you don't have private mortgage insurance, which is one of the greatest things banks do. They can charge you, a high rate, and then they can charge you an insurance policy to make sure you make the rate of which they've already taken the risk for. So you don't have PMI, you have favorable terms. You get to negotiate up front saying, hey, I want to pay, 30 years, or I want maybe this interest rate. And as long as both parties agree, you're able to get those terms that you want.
And there's less restrictive underwriting when it comes to down payment, credit scores, proof of income. We see a lot of self-employed borrowers. We see a lot of I-10 borrowers. There's no debt to income ratios. If you're an investor, there's no limits on how many properties can be financed. And if you're buying with the self-directed IRA, there's a non-recourse option as well. So all of these things are reasons buyers, if you're the owner of the property, might want to use seller financing. So why would a seller finance? Well, we'll talk first about property challenges. So if there's a property that's hard to finance, say mobile home and land, a home on excessive acreage, maybe it needs repairs. If we see a value under 100,000, depending on what part of the country you live in, that could be hard to get financing. If you see a property slow to sell, that's often a good time to think about offering with owner financing. So that would be about 90 plus days on the market is when we start talking about real estate agents might be looking at changing listings if they talk to the seller about it. And anytime you've had a short holding time, a lot of the banks don't like to see short holding times, or if it's a distressed sales sort of situation, those are all reasons a seller might finance. But there's one more segment of why sellers might finance, and that's because they're smart enough to know it's a really good investment strategy.
Yeah, if they don't need the money, I mean, right now you can't walk out and get a CD at say 9% or something like that. So someone can sell it to defer their gains because they're taking an installment sale instead of a lump sum of cash. They may say, hey, this is a great place for me to just let my, equity ride and sell the property, and I can get a good rate, get a good return. I can get the most for my selling price. So if I put a house on the market, I can put top dollar because I'm willing to finance, which means I'm going to have more prospective buyers come along.
And hopefully they understand the benefit of long-term interest income. That interest income is really great for self-directed retirement accounts because it's not active. You're not having to manage the property. And a lot of times people will find that they're getting more net income a month off of their note than they were getting when the property was a rental. So we're seeing a lot of landlords that have seen good property appreciation who want to sell, want to defer the capital gains. And in selling it, they're making more per month because that buyer's paying the taxes and insurance, and they get to keep more of that payment in their pocket. It's kind of an exit strategy as they get closer to retirement to turn their properties into rental income to interest income. So we call that moving from being a landlord to moving to being a lien lord. And so that's that piece of that investment strategy that I'm sure you work with a lot of those people, Dan, as well as we do.
Yeah, for sure. And yeah, what I'm starting to see a lot of is people looking to convert rentals into notes so that they want to keep their cash flow, but then not have all the other responsibilities and overhead. Yeah.
Yeah, and there's some really good strategies for people to create notes under that line. So, and if you're buying notes or even creating notes, there's some great stuff as far as with partials and wraps where you can, create a note and sell off part of it, and then you've got this back end of a note. There's a lot of really good examples of there. Matter of fact, we're going to talk about interest income, partials, and wraps. And so, if we go back to our example.
So we're back to our same example that we looked at earlier with Sam the seller and Barb the buyer. And let's just talk about the interest income for a minute. If Barb the buyer pays her payment of $1,374 for 30 years, 360 months, she's going to pay back $494,874. Now she only borrowed or owed on that note $160,000. So that's over $330,000 in interest. And it's secured by a piece of real estate that Sam the seller knows and likes. And so that in and of itself is why a lot of landlords want to become note holders, is because they want that interest income. But let's say they want interest income, but they also want some money now. They want the best of both, right? Well, they can choose to sell all of that note or part of that note. And it's really great if they sell part of it because they get to keep some payments on the back end.
Yeah, so maybe he needs some of the money. Sam the seller needs some of the money right now, but he still wants to keep some back end of the note. So what he can do is once he's created this note, the same note we've talked about, 360 months of 1374, Sam could turn around and sell, say, the next 10 years of it. So he sells 120 payments to an investor for $100,000. So now Sam has $100,000 to go do whatever he wants to do. But in 10 years, when he gets the note back, the investor will collect the next 10 years. After that, he assigns the note back to Sam the seller. Sam the seller could sell another 10 years or just keep the payments. But at that moment in time, if Barb made her payments the way she's supposed to, Barb still owes $144,925. So Sam has a lot of flexibility here when he, basically has an entire note and sells off a piece of it based on what his needs are.
So remember, he had a $160,000 note. He got $100,000 for selling off 10 years. When he gets the note back, it still has a balance of $144,925. That's because he mostly sold off the interest. And that's why it's really important to think about the interest rate you charge on a note, because that's dollars in or out of your pocket. So we see a lot of people selling partials after they've created notes because maybe they want to go recapitalize and invest in another property.
Yeah, and if it stopped at that moment, let's just say at the 10-year mark, for whatever reason, at that same coincidence, Barb went out and refinanced and got something else. At that moment, Sam received $40,000 down, $100,000, and $144,000. So for his $200,000 sale price, he has roughly $284,000 he's got back out of the property over time. Comes out ahead.
Yeah, yeah, definitely. So let's look at one more example. In the same one, let's talk. There we talked all about Sam the seller owned the property free and clear. But let's say Sam the seller still owed money to a bank, because not everybody owns property free and clear. So if Sam the seller owed money to the bank when he sold to Barb the buyer, then we have to take that into consideration. Barb the buyer makes her payment to Sam the seller, and Sam the seller has to make his payment to the bank. If we look at Sam the seller still owing $151,197, and he had a rate at 4%, maybe he was even lucky he had it at 2.78. There's a lot of those out there, but let's just be conservative and say he got a rate at 4%. He was an investor, so maybe he paid a little bit more than a homeowner. His payment would be $763.86, so $763.86. When he sold to Barb the buyer, he had 324 months left on the bank note that he owed. So he collects $1,374 and he sends that $763 to the bank. So that means every month he nets $610. So he gets the payment from Barb, he sends the payment to the bank, he gets the net. And then when the bank pays off, then he'll get the full $1,374. So this is another great way to leverage, because what you're doing is you're getting 9.75 that you're charging, but you're only paying 4. So there's this spread, there's this 5.75% spread between what you're paying and what you're earning. And that's the power of leveraging when you're talking about notes.
And this is a play that I might run in a couple years when my kids are fully out of the house.
Yeah.
Yeah, because I've got a mortgage at 2.75 that I'd rather not get rid of.
Yeah.
I don't have to.
Yeah.
Absolutely. So, and then we prefer wraps. We hear everybody talk about subject to, subject to. We prefer wraps over subject to, and I'll give you the quick rundown of why. It is because when you do wraps, the party that's buying subject to, when you do a wrap, everybody has a legal interest. So the seller has a legal interest in a note mortgage. The buyer has their deed. Anybody could foreclose if they needed to, if somebody didn't make their payment. We also like these to do wraps because there's disclosures that come into wraps. And then we like to use these with the servicers we'll talk about, because that protects Barb the buyer. She knows when she makes her payment to the servicing agent that they're sending off first the payment to the bank and then the difference to Sam the seller. So there's some caveats with wraps, but we feel if you talk to a good attorney that they protect your buyers better than a subject to.
So is the main difference between a wrap and a subject to that on a wrap, the seller is on the hook for the underlying mortgage, whereas with a subject to, it could be somebody else?
The
Or...
main thing is the paperwork. So if the main thing is the paperwork, yeah, that
Mhm.
when somebody sells with a subject to and they give a deed, they just give a deed and the buyer just buys it subject to. They're really never released from liability, but they don't have anything that they can foreclose or take back if the person doesn't make that payment on their behalf. And so by
Mhm.
putting a mortgage in there, if somebody doesn't do what they're supposed to do on the note mortgage, then they have something they can foreclose, step back in and keep making the payment to the bank. That's the main difference.
Right. So I guess on a subject to, if the seller, for whatever reason, stops making the payments on the underlying lien, then like what happens?
Exactly.
Then I
That's it,
assume
yeah.
it gets messy. Yeah.
That's why we
Yeah.
like the wraps.
That's why we like the wraps.
Yeah, a
Yeah.
good
Yeah,
attorney can
got it.
definitely help with those. So all of that looked really cool. So let's bring it back to exactly what we're talking about today is how do you create valuable notes? Now, as Fred mentioned, a note can be anything. It can be whatever everybody agrees upon. But the closer you can get them to these terms, the better off you'll be. It doesn't mean the note can't be sold. It just means it may not be sold for top dollar.
Yep. So one of the things you'd like to get is a 20% down payment. This is true of any note, whether you're going to buy a note or you're going to create a note. You want to see 20% down payment. Now, we don't always see that. Sometimes, you know, if it was 10% down, which is the minimum, I wouldn't really want to walk in anything that has less than 10% down. We want the buyer of the property to have some skin in the game. And if it was a 0 down deal or a 2% down payment, I just, you know, there's nothing to stop them from defaulting because they don't have a lot of money in it. The exception to that is if I see 10% down, but you know the property's gone up in value over a period of time. Not like, hey, the property sold for 100,000 and 6 months later someone tells me it's worth 200,000. I mean real seasoning where someone's been living there for a while and the value's gone up, or they've paid some of that down. But you want, if you're going to create a note, and certainly in just about most of the markets right now, you should be able to get about a 20% down payment without a problem.
And if you can't, we have some solutions for you, but 10% minimum. Over this 35 plus years, we've been buying notes. You talk to us, you talk to institutional investors, you talk to anybody, less than 10% down has a much higher default rate. Now we're talking about buying new notes. As Fred mentioned, if they had 5, 10, 15 years of seasoning, of course, they've got some equity they built up through amortization or appreciation. But remember, if you have less than 20% down, banks charge you PMI. There's a reason they do that. They also know notes loans with less than 20% down have more risk. They know that. It's been proven. We don't have PMI in seller financing world. And so that's why we are adamant on that, or we do some other strategies we'll talk about here a little bit later.
Yep. The next one's credit score. So when you're looking at it, you want to see a 680 and above. We don't always get that. You know, sometimes, you know, there are different reasons, as we said earlier, why someone might, you know, be needing to buy a property versus traditional financing. Sometimes it's their credit, you know, but this is what's great about this industry is a lot of things can offset. So if somebody walks in with poor credit, but they put a bigger down payment, that helps make up for that. We get to look in our industry at everything as a balancing the scales. We get to look at, okay, there's not a lot of seasoning, but they put a big down payment, or they didn't put a big down payment, but they have a really good credit score and they've been living there for a while. Banks only have a pass or fail. Every one of those categories are pass or fail. And if it fails, the whole loan's not available. So we want to see a 680 plus credit score, again, to have a better note that is less likely of a default.
And I'd rather have no credit, like an I-10 buyer, than I would bad credit. Or if you see bad credit, you want to know that it's a one-time life event. So in our Creating Notes Masterclass, we talk about, well, if this happens, what about this? If that happens, like, how do you balance the scales, like Fred mentioned? So we recognize that a lot of deals don't have this credit score, but we're trying to start with an optimal level. And then what do we do when it's not optimum? The next thing we like to see now is at least 9 to 10% interest fixed. If that's a single family home, if you're talking land or mobile home and land, it would be higher than that. We like to see 20 to 30 year fully amortizing. If the buyer is going to live in the home, we don't recommend any kind of balloon payments. A balloon payment's when somebody owes more that doesn't pay off in their normal monthly payments. And then you mix this all up together in the pie, and you make sure that your buyer borrower has the ability to make that payment compared to their income.
Yeah, and I just want to say one thing about 9-10% interest rate, because that's what we like to see. A lot of people watch this, or when they first start getting a notes, going, "How am I going to get 9 or 10 when the bank is out there giving 7?" My answer to that and to the buyer is then go get traditional financing. I mean, if you qualify for 7, then go get 7. If you qualify for 6, go get 6. But if you want me to hold the paper, then yeah, it's 9 or 10. And usually we try to stay right under 10 because you can go 9.75. It's not 2 digits depending on what they qualify for. Now, someone comes to me and says, "Hey, I'm not real happy with you want to charge me 9.5." Say, "Okay, well, if you put 30% down instead of 20%, I'll lower it to 8.5 or whatever it may be." So they can buy that rate down a little bit as we do that negotiation process.
Yeah, and I think one of the big mistakes like rookie seller financiers make is, yeah, they look at bank rates and they
Oh,
think they
yeah.
should do that, because if you turn around, you're going to sell your seller finance loan on the market, people are probably looking for a double-digit plus
And I think
return.
that's a good point,
Yeah.
because at the end of the day, when we go to invest in notes, the discount is the difference between what I want to earn as an investor and what you wrote the face rate of the note is. And if you're writing a note at 4 and I want to earn 11, that's a big discount. If you write the note at 10 and I want to earn 11, that's not a big discount.
And exactly what you guys are talking about, we put a chart up here because we like to drive that point home a lot. So we talk about if you had this same note balance at 160,000 at 9.75 that we've been talking about, and Barb the buyer is paying Sam the seller $1,374 and some change. If a note investor came in and was willing to buy this 9.75 note for a 10% yield, it'd be a very small discount. They'd pay $156,642 for that $160,000 balance. Theoretically, if they wanted a 9.75 return, they could pay $160,000 for 160. That would be par pricing. But most investors want discount pricing. But let's see what happens when you lower the interest rate.
Yeah, as someone creates a note with a lower and lower rate, in this case 9, I still want to earn 10 as an investor. Now, again, the difference comes between how much I want to earn and what you wrote it for. I want to earn 10, you wrote it for 9. I can only pay $146,000, $699 for this same cash flow.
Yeah, and the payment does go down for Barb the buyer. That's good. But also what you could resell the note for will go down. Now, if your investor wanted 10 and you wrote it at 7% and that monthly payment went down to $1,064, now an investor would only pay $121,298.
Yeah, and just look at the difference between, say, whether you wrote it for 7 and 9.75. That's over $30,000 difference in purchase price, and that's if somebody wanted 10. And you go all the way down to 6. Now we're at $109,000 buy price instead of 156, and then hopefully no one is. I mean, we do see notes at 5, and we do see notes at 0. 0 is usually a problem property to begin with. But even 5%, to Dan, your point about saying, someone looks at what the current rates are or whatever and go, "Oh, let's write the note at 5." That's great. And if you want to earn 5 and you're happy earning 5, now I wouldn't create a note at 5 because I can get almost 5 in a CD. So why would I let a property ride close to 5 when I could just turn around and put that in a CD just shy of 5? And again, look at what happens in the event. And this is what I said in the beginning of the show, is that you may be creating these with never the intent of selling them. And you may be going, "Hey, I'm happy with 6% or 7%. But what if someday you do want to sell it? In this, you're able to get more cash flow if you can keep it a little bit higher."
And we're seeing a lot. I mean, I love it for buyers. If you're a real estate investor and you're negotiating seller financing as the buyer of the property, and you're getting that Sam the seller to carry it, and you're getting them to carry it at 0, you are very happy because you're like, "Oh my goodness, 0%." And maybe you're making up for it. You're paying more for the property than it's appraising for. But the challenge is, if when Sam the seller goes to sell that note, the note buyer, the note investor, they're going to use the lower property value, and they're going to calculate in that 0%. And poor Sam the seller is not going to be able to get much for his note. And when we're comparing all these different things, only $50,000 for that $160,000 note at 0%. So the lesson of this is rate matters. Think about that when you're creating valuable notes.
Yeah, there's one interesting caveat to this that I learned about recently that I've seen. So I've seen a few cases where people are doing wraps and they don't want the buyer to refinance or pay off the loan because they want to maintain that cash flow. So in a few cases, I've seen investors actually move the interest rate a little closer to the bank rate and maybe a little lower than they potentially could, just so they're helping remove an incentive for the borrower to refinance or repay that loan in the future so they can keep their cash flow
It's
on the
definitely a
wrap.
spread.
Yeah.
Yeah, it's a spread strategy. So for, let's just say for some reason I somehow got 3%, and it might be a reason for me to write the note at 6. So hoping that they don't go out and refinance. And I understand the math of it. I understand the idea of it. But the reality is that a lot of people will move or their life situation changes, which is why we have a 5 to 7 year payoff. It's not necessarily all refinancing. They go to move. And if they have to move, that old strategy didn't matter at that point anyway. And how much did it cost them in that period of time while they are waiting those 5 years, hoping they wouldn't refinance? I get it. I probably personally wouldn't do that just on the off chance that I ever want to sell, because it only works in a hold environment. And we're talking about creating sellable notes. It's not a bad strategy, especially because you're using bank money to hold that spread. But if you get boxed in the corner and you have to sell, and you wrote your note at 5 or 6 trying to hold it close, or they went ahead and paid off in 2 years because they moved and needed to sell it off and move, you left money on the table at that point.
And one more
Yeah.
caveat to exactly support what you're saying. What if, and I just play devil's advocate because we've seen it all. What if the bank decides that they're going to call this due because there's been a transfer of ownership? One of the things you can do is sell your note and pay off the underlying. That's what we tell people all the time with wraps. Make sure you're creating a note that if you had to, you could sell the note to a note investor and you could pay off the underlying and walk with enough money. Well, we just showed you how much difference that interest rate matters. So if you wrote it at 5 because you were happy with a little bit of spread, now you've got to sell the note to pay off the underlying because they've called it due. Ouch, it hurts.
Yeah, that's a good point. And I'm going to get on my soapbox a little bit on this one, because I've talked to a lot of people. They have the strategy of, because I've asked them, like, what happens if the bank calls in the note? And it's like, oh, I've never seen that happen in 20 years, or that won't happen. You cannot, I mean, whether you're talking about notes or any investment or anything, you cannot have a strategy where the whole thing hinges on something that never happened before, never happening again. And if it does, you're dead. Like you can't do that. Cause I mean, how many examples are there in history? I mean, part of the financial crisis was, part of the reason people got so levered into housing debt. It's like, oh, it's never crashed until it did.
Yeah.
Right. So if everybody starts doing subject twos and wraps, leaning on that, it's like, yeah, banks have never gone and called them all in. But if you start to have problems because so many people are out there doing that and doing the wrong thing, you can induce that to happen. Yeah. So you just have to have some plan for what happens.
And I think that's good advice, because let's talk, I mean, hypothetically, let's just say that traditional bank loans went too low. That's not even the hypothetical part of what I'm going to say. And you're a bank and you're holding all this, and you want to go search and make sure that none of your 2.75 loans actually had any of that, and you wanted to call, due on sale and call those. There's incentive for them to go in and do that. So yeah, just because it hasn't happened, and it's, the machine's usually churning, and as long as the payments come in, doesn't mean they can't. And you have to prepare for the event of that happening. And we have seen it very rarely, but we have seen it.
We have seen them in our lifetime that where the banks have called it. Not often, but the people that have planned for it and have exit strategies for any situation, profitable exit strategies for any situation, are the ones that survive to see the next. So I was over nodding my head for anybody who was listening and not watching the replay, because we 100% agree with you, Dan.
Well, that and not only to agree with you, yes, we did not see it in the last 20 years much. I also didn't see 2.75 bank financing out there in 20 years either. So there's a different environment out there that makes it a reason for them to call it.
So all these things we're talking about is part of why when you're creating notes, you don't want to go this alone. You want to use professionals that have seen it, because so we talked about all the cool, really great
Here's the
stuff.
scary slide.
Here's the scary
No,
slide.
it's not that scary. It seems scary, but it's not.
There's an alphabet soup of lending laws out there that may or may not apply to seller financing, because there are certain what we call carve-outs for seller financing. But please know that when the Dodd-Frank Act came in January 2014, that it applies to some seller financing transactions. And there's something in there very specifically that talks about being sure the borrower has the ability to repay, that they can afford the payment, and that the seller of the property or the bank is making sure people can afford that. And that just honestly makes good sense, because you want to create a note, you know, that your borrower can pay. And if you ever sell that note, they're going to want to know that. But when we talk about Dodd-Frank, we talk about the CFPB, the Consumer Financial Protection Bureau, that's in charge of enforcing it. We see SAFE Act laws, and those can vary by state. We see usury, which is the maximum amount you can charge an interest rate that varies by state. There's things called truth in lending, Reg Z, all these laws that apply to true banks lending money, and in some cases, seller financing. You've got RESPA, you've got fair debt collection practices, you have Fair Credit Reporting Acts. So all of these things are said not to scare you, but to tell you that you want to use professionals when you're creating valuable notes, and you want to have a team. So your solution to all those things is to build your team. And your team's going to look similar with some differences, as you might normally see in real estate. You might have a real estate agent, you might not. You definitely want to have some kind of closing agent.
You're going to have a title company as normal. You're going to have an accountant or CPA that tells you how to create notes. But the two that you're probably going to add in here, one is very recent to our industry, which is the mortgage loan originator, MLO. And Dan can obviously talk a lot about that. But, you know, when this first came down, everybody says, oh, you got to use MLOs. And I'm like, oh, it's scary and it's regulation. Again, to what Tracy said, we want to have buyers that have the ability to pay. We don't want, you know, look, anybody that had a problem with this long term was, you know, and I'm not saying anybody, you know, if you're creating shady deals and you're one of those bank, you know, people that got caught going, we're trying to, you know, make people put a down payment. We know they can't pay, and then we're going to take the house back and then flip it again and do it over and over again.
Wrong.
We don't want those people in our industry, and we don't want buyers that can't afford properties in that. So our ability to use an MLO now and make sure that that person has the ability to pay going forward is just one person on your team we're going to do. And this is newer to our industry, and I think it's great.
And you're thinking, well, MLOs have been around a long time in the lending world. Some people call them an RMLO, residential mortgage loan originator. But more recently now, they're being used for seller financing. Because why? Because you've got a third party that is qualifying the borrower, sending out disclosures and doing paperwork, taking in an application, verifying debt and income, pulling credit, all these things that make it look like a traditional bank loan, even though it's still seller financing. And Dan, I know this is something dear to your heart, because you recently purchased Call the Underwriter, and it's exactly the service that Call the Underwriter provides.
Yeah, exactly. You know, and I spent most of this year really deep diving on all this stuff, because I was actually looking at spinning up my own version of Call the Underwriter before I found out Max was going to sell and buy it. And I'll tell you what, like there is this alphabet soup of regulations that you showed, and it literally took me like months to sift through all of that stuff and kind of begin to get it. And even then it's interesting, because there's all these regulations and they're overlapping. And I've even had cases where I've talked to different attorneys that have given me different opinions on the rules, and they're not all as black and white. However, at the end of the day, I would say, and it's interesting, like having gone through it, I'm definitely no fan of having a bajillion government regulations to do something. But when you actually get down to the nitty gritty, everything they tell you to do, it kind of makes sense, right? Yeah. Like if you're creating a loan, it's kind of in your best interest to make sure that the borrower can pay. It's obviously good for the consumer. I would say the rules make a lot more sense than I expected when I got into it. And I know like a lot of people, like their reaction is they see that and they get super scared. Like there's a lot of people I know who will only do investor loans. So like they'll say, okay, I'll stick to hard money loans, or if I'm going to do another loan, it's going to be an investor loan, so I don't have to worry about all this stuff. it's really not that hard if you use like the team that you're showing here, right? And it's not really different than any other pieces of the puzzle, right? Like I wouldn't do a DIY title company. Like, yeah, I could, but that would be really hard. I wouldn't do like
Right.
DIY attorney work. Like, yeah, those people had to spend a lot of time figuring it out, but now they've got their systems and their processes, and you can just hire them and do multiple ones. Like it's pretty easy, right? So those regulations, while they're there and you need to do things the right way, they really shouldn't slow you down much or prevent you from doing what you want to do.
Yeah, and to your point too, you can pass these costs on to the borrower, and they are still paying less in costs than they traditionally would through a bank loan. So the cost for an MLO or even a servicing agent, the servicing agent's that third party that collects the payment every month from Barb the buyer, keeps track of interest and principal, makes sure taxes and insurance are paid. And so they send the payment on to Sam the seller. So that MLO and that servicing agent really elevate whether you've created a valuable note or not. If the people would just do those two things in addition to the normal title and closing, they would really have a note that protects them and is also valuable if they want to resell it. So if people are listening going, what about the investor loans? Yeah, because Dodd-Frank automatically says it, sales and loans to investors don't fall under that. Now that may vary by your state, but generally that's true. But you're missing. And when Dodd-Frank first came out, we all said that. We're like, well, we're just going to buy loans before 2014. Well, we're just going to buy notes that were to investors. Well, that worked for a few years, but
Yeah.
now here we are in 2024. We'd like to still be around buying notes. So the solution is to use an RMLO and use this servicing agent so you know everything's in compliance and you don't have to worry about it. Like you just said, you don't have to do it DIY.
Yeah, and not only just compliance, it's also, I mean, this is kind of a forced best practices. So even if you're doing investor loans, and yes, you can skirt a couple of these things, why not operate your business? It's your money. Why not operate it with the best practices possible? And in this case, if we're not doing investor and we're doing traditional, an MLO and a service agency are going to help me maintain the best practices to make sure that I'm going to get paid and have a note that's sellable later.
Lots of people use MLOs when they are doing an investor deal. You still want to make sure that that investor can afford the payment, or the property can afford the payment. The rental income can cover it.
Yeah, Call the Underwriter has a lot of clients doing just that, right? Because the process has value regardless.
It's a screening process. Even though it's not a requirement on an investor, it's a great screening tool.
I mean, would they go out and rent their property to someone without doing some kind of check on them? I doubt it, right?
Yeah, and like for investor loans, right? Like there's different ways to underwrite it. Like, some people will use the income method. You could say, hey, I'm making a loan to this person who's going to have this house as a rental, and I know it rents for X, but it's kind of a nice belt and suspenders if you know that that person has the ability to pay you, even if it's not rented.
Sure.
Or like, what's their credit like, right? Like, okay, it could well be that this person's going to rent the house and they can rent it for more than they're paying you. But if they're the kind of person that doesn't like to pay their bills, that doesn't necessarily mean, rent skimming's a big thing. I've had a lot of borrowers do that to me on notes that I've owned. So yeah, there's really value in that either way. So
100%. So we talked about scary stuff. Let's go back to why this might be a deal that you would want to go to the effort of using an MLO and a servicing agent. Just remind you of what the opportunity is out there. So this is a transaction that was in Texas. It sold for $210,000.
Yep, it's Mesquite, Texas. I'm not sure if that's where the wood comes from or not, or they just named it that way. But sale price is $210,000. The down payment was 9%, so not a great down payment. It's already lower than we like. $18,350 was the down payment. But this is where we can get into splitting the deal up. So it's a first, which you create a first and a second note. So you create a first note at 75%. And that's $157,000. And then that's at 9.5. So it's $1,300 and change a month. And then that helps. We sell that note to cover whatever. So maybe we're a flipper, maybe we're something. This covered our cost to acquire this property and turn around and sell it.
Or if we're lucky, it's even more. We put a little money in our pocket. So as long as we paid less than 152 in this scenario, we get to walk with the 18,350 as the seller. And even that is a good deal, right? We get to walk with the down payment. But what we did here was because the buyer didn't have that 20% down, and we know an investor who buys a note is going to discount it because they're going to want to be lower on their investment to value. Because we did the 75% first, we carried the rest as a second. So the second would be a 34,650. So just to back up, if you have a 210,000 sales price, a down payment of 18,350, the first is 157,000, and the difference is the second, 34,650. It's basically that amount of the down payment that buyer couldn't bring in to get to 20%. And now you would hold that. And this is what this particular group with the Creating Notes group did. And he held this for 10.5%, a little higher rate than the first, for 30 years. And he got $316.96 a month for those 30 years. Now, if you put that into a calculator, you say, I got all my money back. I even made some money at closing. I got to keep the down payment. And I've got this cash flow of $316 a month for 30 years. And you ask it what your return is, you're going to break it. You're going to get something called an error 5, because it's an infinite return, because you made all this money without keeping money in the deal.
Yeah, this was saying earlier that a lot of flippers missed out. So they would buy a property, say they bought this property for, $175,000 or whatever, 170,000, and they turn around and sold it for 210, and they walk with a check, and now they go find another property. This is where people like that were really leaving money on the table, because if they acquired this property for, say, 145,000, and then they put a little bit of money into it, but they create a first and a second, they sell that first for 152, plus they kept the $18,000 down payment. They've got all their money back out of the property, maybe a little bit extra to go move on to the next property, but they have a cash flow. They have that second that they didn't have to discount it or sell it cheaper, the property cheaper, to get out of it and get their cash. And if they get a couple of these going, now they have cash flow that's out there for a while. Now, I should say, in full disclosure, these seconds are largely not sellable. This is about keeping on the profit that you're not having to put on the table. If you tried to sell this second, no one's really going to want to buy a second when they didn't put much down and stuff like that. But you're buying that for a cash flow play.
So how do you do cool things like this? Very quickly, these are our 10 steps. You've got to identify your team first. You've got to figure out your sales price and what terms you want to start with. Then you're going to market your property with owner financing. And you're going to pre-qualify before you agree to sell it to them by getting an application, an authorization, some income information. Based on that, you're going to negotiate the terms.
Yep. So you're going to put an offer, an acceptance in writing with some earnest money. You're going to underwrite. This is where we're really going to make sure that everything in the application, right? They're going to underwrite, credit review. This is where we're going to use an RMLO to make sure that they have the ability to pay. We're going to do title and complete all the contingencies that are on there. And then we're going to set up closing and record and close and do all this,
and then set up servicing. So each one of these steps, of course, has best practices involved in it, but that's basically, in a nutshell, how it works. It's exactly what we cover under our Creating Notes Masterclass.
Cool. Well, you guys did cover a lot of ground. That was intense.
Yeah.
So
and it's hard because the Creating Notes Masterclass was a full 2 days on just creating notes. And where we have to deep dive into this and a lot more. We talk about working with MLOs and the fundamentals and how to analyze it, and we have some interviews in there and stuff like that. So we actually created an entire course on this, on just creating notes. We have several master classes, but this is the one that's definitely very appropriate for what we're talking about here. Anybody that wants to create notes either to hold or create notes to be able to sell. Anybody that's currently, has a property that, is a rental that they want to convert into a note, convert into a cash flow.
Yeah, we do a lot of strategizing on how to take a transaction and then turn it into a note that you could do a wrap and sell off a piece, or you could do a partial. How to structure those, what happens if you do have an ITIN buyer versus down payment, how to work with your RMLO, how to set up servicing. We do sample documentation. We always recommend you have your documentation reviewed by the attorney and title company. But we found over the years that, having a place to start and knowing what's standard is always helpful, saves you money when you're working with them. And we have called the underwriter on there, doing a series of interviews and working with MLOs as well. And so I know, Dan, you and I were talking about that. You're like, you need you know, as you're developing all this, what can we do to help people create notes and send you a good package? And just having
Mhm.
these steps and the best practices available to them with videos that explain them really helps.
Yeah, and anybody that has the master class, you basically these are on video. You can watch them at your own pace. You can actually ask questions in the training that we get, and we answer the questions in there. So there's a QR code on the screen that you can hit and go to a special link for that.
Yeah, and I'll send the link out to people afterwards. And actually, I did get the Call the Underwriter website updated. So actually, if you go to the top of the Call the Underwriter website, like there's a link
Oh,
to the
nice,
course on there that's kind of
nice.
permanent now. Yeah.
Yeah.
So what do you, I mean, we're seeing this a lot, Dan. There's a lot of opportunity for people to understand how to create valuable notes. We have a lot of people that work with us that are actually boots on the ground working with local real estate investor groups. They're applying this to their own deals. So, you know, if you just know your team and you're a piece of that valuable team as part of the Call the Underwriter, and you're part of that valuable team as somebody who buys notes as well, right? You and your
Mhm.
group, you have a mentoring group that you work with, and if notes are created well, they're willing to buy them.
Yeah, and the good thing is so many of these are being created, right? So I think,
Mhm.
you know, when you guys do your 2024 update to the statistics you showed at the beginning, I bet those are going to increase. Because yeah, I need to sit down and make a presentation of like all the reasons behind why people do seller finance, but there's a bunch, right? Like there's people doing wraps, like we talked about. There's people who are doing like what I've done a number of times, which is like I had a non-performing note, I foreclosed, and then I did owner finance to dispense of the REO. There's people just buying properties for cash, you know, so they'll kind of like get a discount, buy
Mhm.
it for cash, and then sell on terms. You know, there's people do it as part of an exit to fix and flips. There's the people converting rentals, and I'm probably leaving out like 10 others. But yeah, and I think we're gonna, as creative finance becomes more popular, I think we're gonna see more and more and more and more people creating those. So even if you don't want to create them, yeah, and you just want to buy them, we should
Yeah.
see no shortage of these.
Yeah, and you know what else I'm seeing an increase of, which I know when you talk about soapboxes, we're all trying to help people avoid this, but I'll see zero down, 0% interest rate, poor credit, or no personal guarantee, and they want to sell that note. And you're just like, give me a
Yeah,
reason, please, that I should.
it's kind of crazy how, you know, we just talked about like all the rules that have been in place since 2014. There are still a lot of people out there doing stuff like it's the 70s and
Yeah.
there are no rules and just doing whatever. There's a lot of that stuff out there. I don't know if they're actually reselling the paper, if they have any hope of doing that, but there's actually a lot of that stuff floating around out there. And I also understand now why it was funny, because a while back the CFPB made an announcement about land contracts or contract for deeds and
Yeah,
how all the consumer rules apply, which at first I was like, well,
of course.
all my attorneys always advised me that way. And I'm like, why are they doing this? But now that I'm getting exposed to some people who are trying to use land contracts too, or they're also trying to do it to in some cases reduce the chance of a due on sale clause getting triggered because they're not recording the land contract and there's not necessarily a deed passing, and there's still a lot of people who think that all those rules don't apply to those, which is not true. So despite like 10 years of all those rules and probably the majority of people being overly afraid of them, I would say there's still a lot of people just letting it rip.
Mhm.
So
What rules?
Yeah.
yeah.
We always say we're here for longevity, and we you know, we don't want to have problems. We want to have borrowers that pay. I'm not saying that some borrowers might not have a one-time life event, that something happens and we have to work with them. I mean, sometimes people get ill or they lose a job, or these things that that make them become non-performing. We have to work for them to get performing, or we've got to help take a deed in lieu of foreclosure, but our servicer can assist with that. But all of those things, but we want to set ultimately up for success. So the buyers end up owning the home and we end up collecting payments. And if a note gets sold, our investors end up getting their payment. So ultimately, it's not that much more work to do it the right way by using an RMLO, as some people have said. Wayne in the comments says he uses them on all his seller finance deals. So it meets Dodd-Frank's. The note is worth more if I ever need to sell it. That's an exact summary of why we do this.
Yeah, I mean, if you think about it, you can pass all the costs on to the borrower, so you're not actually paying for them, and then your asset becomes more valuable.
Yeah.
So it's kind of a
Yeah,
easy sell. Yeah, that's kind of
for sure.
cool. Well, thanks so much for joining. Really appreciate it.
Yeah, thanks for
We'll
having
be
us.
doing this again. Yeah, you guys are welcome anytime. Like I said, we could take any of those 10 topics and probably do another 2 hours
Yeah.
on them. So there's no
Well, that's
shortage
what
of
I love
stuff to
about the
talk
industry,
about.
though. There's so many cool strategies and stuff. I mean, we have an entire course on just parcels. I mean, you can drill down on any of this stuff, but I think hopefully it gave people that are interested in creating some notes the ideas of where to go. And even if you're investing in notes, it's a good idea to know how they should be created. So as an investor going, oh, I didn't think of that as an investor, that I should be making sure they did this on that note. So there's a good angle for those people as well. Yeah.
Yeah.
Thanks for
All
having us,
right.
Dan. We
All
appreciate
right.
it.
Thanks, Dan.
Thanks again.